Did you know that in order to get a perfect credit score, you need at least 20 active credit cards? And I wish I were joking. But did you also know that the difference between a 650 and an 800 credit score can cost you hundreds of thousands of dollars, if not millions, throughout the course of your lifetime? What I want you to do is to forget everything your mom, your dad, schools, and your friends have ever taught you, because what I'm about to show you is about to change the trajectory of your life forever. And if you don't think it's important now, you will think it's important when you want to buy your next car or your next house, and you'll be thankful you watched this video. In this video, I'm going to break down how I obtained an 800 credit score and keep it there every single month without paying for any additional credit repair services or any consulting. My name is Rios. I have over 30 plus credit cards, as you can see here, and access to over 300,000 credit line limits that I use to invest in my businesses, and I teach others how to do it from scratch. So without further ado, let's break into this video. But before I break this down, what I'm about to tell you actually isn't public knowledge. What I'm about to tell you is the reason why a lot of people don't have good credit or don't understand how to properly leverage their credit to actually make money. So let's actually break this down so you know how to approach having a very good credit score that you can actually leverage. So there are 5 factors that determine a perfect credit score. One of those 5 factors being your payment history. This makes up for 35% of your score. And what this means is you cannot have any missed or any late payments. The biggest misconception behind late payments or missed payments is that people don't understand when and how they report. There are 2 dates that are very important to understand when a late or missed payment is going to report. And these 2 dates are your closing date and your statement date. The closing date is essentially when the banks will report your current credit status to the bureaus. The statement date is the end of your 30-day billing cycle. But what does that mean? Let's say you open a credit card on January 1st. You have 30 days from the date that you opened it to be able to rack up your debt and pay off your statement. So in this case, it's January 30. From January 1 to January 30, let's say they gave me a $1,000 credit card limit. So I decided to use $500 of my $1,000 available. In this case, it is 50% of the total amount of credit I've used. The statement date ends on the 30th, but the closing date usually is 3 days after your statement date. So in this case, we're talking about the 2nd of February. So what people don't understand is that when there are late payments or missed payments reported, your closing date is 3 days after your payment billing cycle, but you are still within the 30-day time span. So the only way a payment reports that it's late is if you let another 30 days from the original statement date report throughout the next closing date. So in this case, you will be looking at March 3rd. Within those additional 30 days, if you let the balance accrue, there will be a missed or a late payment reported. So the question here becomes, with your payment history, do I have to pay my debts before the 30-day billing cycle or after? Because banks have an internal score, and their internal score is all dependent based on your relationship with them, it is recommended to pay your balances before the 30-day billing cycle ends, which is the first billing day, 30-day billing cycle. If you keep paying your balances after the 30-day statement date, the banks are going to start flagging you as a risk. The banks will start cutting your limits, or they'll start reducing the amount of money that you can spend. And in this case, why would you want that to happen? The second factor that's going to contribute to a perfect credit score is now credit utilization. This makes up for 30% of your score. And usually what this is how much credit you are using. So based on my previous example, if they gave me a $1,000 limit and I am using $500, that is 50% of my score. The rule of thumb, in which you will see everywhere on social media, it is only use 30% of your available credit limit. But actually, that is a lie. When you use anywhere above 30% of your credit score, they start flagging you as a potential risk. Let's say you have me and somebody else who are borrowing money, and you are using 35% of your total credit, and I am using 10%. Who looks more responsible with their money? It is obviously the one who is managing their debts, who has a better payment history, who is able to leverage their credit correctly. How much bank account funds do you have to be able to pay back your balance? These are internal scores that actually start flagging systems within specific banks. So in this case, the real number of where you should keep your credit score, or credit utilization, should be below 10%. Number 3 is your length of credit history. What this means is how old is your credit? If you have one credit card that has 12 months, and you have another credit card that has 24 months, you now have 3 years total. So what they will do is that 3 years divided by 3 credit cards, your now average age of your credit is now 1 year. So what they did is they added up the entire amount of months divided by all the credit cards that you have, and that's how they get your length of credit history. Ideally, the older your credit, the better lenders will work with you in terms of interest rates and opportunities. But there's a big misconception. How many accounts you have versus your age is also an indicator of how much money they will let you borrow. So the goal is, when you are building your credit, to choose high quality accounts and to be strategic about when and how you apply to these credit cards, so you have a very high selection of amount of credit cards, and you have a really good age that will not make you seem like you are new to credit. Fourth one, this is now your credit mix. This makes up for 10% of your score. And what this is the amount of diversity there is under your credit. There are two types of credit. There's revolving loans and there's installment loans. Revolving means that the amount you owe differs every single month. So stuff like credit cards is an example of revolving loans. Installment debt, this is debt that where you signed a contract in which you owe an agreed amount for a specific period of time. In this case, it is a car loan, a student loan, etc. But the biggest misconception here is that these two different types of loans are treated very differently. Installment loans do not affect anything regarding your credit utilization at all. These are treated differently. So your credit mix, which is 10% of your score, they want to see diversity. How well can you handle your commitments to agreed loans and variable loans? A good credit score has to have at least 2 installment loans reported that are making consistent payments to their credit. The fifth and final factor is new credit, otherwise known as hard inquiries. Inquiries is when you apply to a new creditor and the creditor takes a look at your credit report. You might hear this as a hard pull, or you may also know this as a soft pull. Soft pull means that banks will not be checking your credit report. It is a soft pull. That means they will not be checking and they will not be reporting a hard inquiry to your account. But the biggest misconception here being that if you apply to new accounts consistently, it's going to hurt your score. Well, as you heard previously, the more accounts you have, the better, because this proves to the bank how well are you able to handle your debt. And you have a lot of access to debt. Keyword is access, not active debt. It shows the banks that you know how to manage your money. So when banks look at your hard inquiries and throughout the span of 1 year, they see that many accounts were actually opened and you are managing those debts correctly, they stop affecting you within 6 months. The key here is to be able to leverage your report to be able to apply to new credit no more than 2 hard inquiries every 6 months. You don't want to make it sound like you are desperate for new money. In this case, you are a risk, but you don't want to make it sound like you are absolutely shitting the banks and you are trying to use them for money. You want a little bit of both. You want diversification. You want to prove to the banks that not only are you able to handle your money, but you're able to pay your debts correctly, you're responsible with your money, and you actually have knowledge and age to prove action-backed experience that you are able to handle credit correctly. So now that you understand what actually contributes to a perfect credit score and you need to up your credit score fast, here are some methods that have worked for me and multiple other people in the past. Number 1, if you don't know what your credit score is, you can actually pull your credit score for free by downloading Experian or Credit Karma, and they will actually give you a free version of your report to get an accurate representation of what your current credit is. Remember, you want to have at least anywhere between $25,000 to $50,000 in credit. You want to have at least 2 installment loans reported. You want to have no negative payments, no missed payments, no bankruptcies, no collections, etc. If you're somebody who doesn't meet the criteria, you can actually go to creditstrong.com or self.inc. You can actually quote unquote fake your installment loans. And a lot of people don't actually know about this. So how this works is these 2 accounts will be able to have a savings account specifically just for you. An example, I'm going to come into an agreement with you and tell you, hey John, we can make a savings account for you, but we're gonna report this as a credit. Naturally, how people view this, they're going to say, what are the fees behind this? The fees being that they're gonna take a very small percentage of your savings account, but you're going to come into an agreement with them in which you have to pay them a specific amount of money every single month. If I came into an agreement for $2,000, we're going to come into a 24-month agreement in which they will charge me $150 to anywhere between $50 to $150 a month. You will consistently pay those anywhere between $50 to $150 a month throughout the 24-month span the entire time it's going to have it in a savings account. So this savings account will keep growing bigger and bigger and bigger till the end of the term. They're going to give you all your money back in return. They're going to report all of those payments into your credit report to make it look like you have an installment loan that has been successfully paid off. If you are in the process of buying a new car, a new house, etc., and you want to show more credit worthiness, I would definitely recommend checking out both of those options. And for those of you who don't want to get into Credit Strong or don't want to use Self.Inc., there's actually another hack in what you can do to be able to finesse the installment loans. For those of you that are new, I've talked about this multiple times back in my free community. This is called a pledge loan hack. What this hack allows you to do is basically known to work with Navy Federal. And Navy Federal is a bank that only works for people in the military or families of members in the military. But I'll show you how to get there in just a second. You will come into an installment loan agreement of $10,000, but you have to have $10,000 in cash. What they're going to do is they're going to use your $10,000 as a collateral. In the event that you default, they are going to take your deposit. In this case, it's $10,000. But the trick here, most of you are probably asking, why the fuck am I going to give them $10,000 to get a $10 credit? The trick here is to leverage and finesse your credit report. It's once they give you the exchange of $10 in cash into $10 in credit, you are now going to pay $9,990, about 99% of the loan, within the next 30 days. When this happens, what Navy Federal will do is for the remaining 5 years and 11 months, if you came into a 6-year agreement, they're going to now divide the remaining payments, in this case it's $90, into those remaining 6 years. So in this case, you're now able to afford a loan, and I'm pretty sure most of you can afford $5 a month, to be able to build credit for the next 6 years. And you'll be able to finesse your payment history because you make consistent payments at a $5 a month ratio, and be able to get an installment loan reported for the next 6 years. People also do this with DCU and other credit unions who have this option available. But it's very important to check with your local credit union about collateralized or subsidized loans to see if their process works similar to Navy Federal. Number 3, if you're somebody who has high utilization and you want to drop your utilization fast, because again, this makes for 30% of your credit score, the quickest thing you can do is actually get a credit line increase. And to keep this simple, this is how it works. Let's say you have a $10,000 credit card, you're using $5,000 of those $10,000, that is 50% credit utilization. The trick here is to ask the bank for a credit limit increase. If they extend your credit limit from $10,000 to $15,000, your credit utilization went from 50% to now 30%, which now you should see a positive increase in your credit score. But keep in mind, this only works if you have a utilization 50% and below. This will not work if you have 75% and above because you already seem extremely risky to the banks. The only way this will work if you have above a 70-75% utilization is if you make the payment, you pay it off in full, and you do that twice within 30-day billing cycle. Because then the banks will see that a credit limit that they gave you is actually extremely small compared to the amount of money that you spend. The more credit you have, the lower utilization will be reported if you have a large credit limit, which is the reason why people like me have over $300,000 in credit line limits, because I can spend $30,000 without worrying it tanking my credit score. So now that you understand how to properly structure your credit, here's how to actually leverage your newly acquired credit into actually making some money. The more money you have, the more money you can spend. And the more money you can spend, the more money you can make. So number 1 is you have to find an opportunity to be able to make money. And this can be literally anything. This can be Amazon FBA, this can be e-com, this can be reselling, this can be stocks, this can be investing, this can be real estate, this can be crypto. The point is you need to find an opportunity that best suits you. You now have to leverage credit to be able to invest into these opportunities. But if you want to leverage this credit without ruining your credit score, here's a hack that I use all the time where I can manage my risk and not fuck up my credit. What I do is I go and apply for business credit cards. Business credit and personal credit are treated differently. Business credit does not show up on your personal credit. So if you apply for an LLC and you register for a business credit card, banks will not be able to see this or what you use, what you spend on your personal credit report. So effectively, you are hiding your spend and you are hiding your credit under your business account rather than your personal account. I will apply to business credit and I use my business credit to make business opportunities. And why do you think that is? Not only do they not report to personal credit, but they actually give higher credit limits to business accounts rather than personal accounts, because it is known that businesses require more money. And if you think about it from the grand scheme of things, I say fuck it, because business employ people, people pay their taxes goes to the government backs up the banks. So why would I do that? I'm helping boost the economy. And that's just good with my conscience. But that's not all. You can actually use this credit, invest into the business. If the business makes money, you actually get perks like credit card points and cash back. So effectively what you are really doing is you are taking these large amounts of credit, using it to make money, being able to accrue rewards with credit card points and cash back, which you can then use to travel for free. So in this case, you are effectively getting paid to invest in your business or create one and travel. That sounds like a really good ROI. If it doesn't sound like a good ROI to you, then feel free to keep working your job and keep paying full price for everything. And then once you have a successful business, all you have to do is just rinse and repeat this process. And if you don't want to do this, at the very least, you have built your credit enough to be able to get the best interest rates for a new car or a new house, because if you don't know, everything requires credit. When you want to buy a car, they check your credit. When you buy a house, they check your credit. When you get a specific job, a very high degree job, they're going to do a background check by checking your credit. So the key here is that your life now becomes easier because you know how to leverage credit instead of letting credit control you. You should now know how to properly structure your credit score, how to actually boost your credit score fast, and different ways you can actually leverage your credit to improve the quality of your life. And everything mentioned in this video is free. It just takes a little bit of research to do. And if you're looking to not only boost your credit score and you want to start leveraging your credit into actually making some money, I create a program that does exactly this. Within the next 30 days, I want to help you leverage your credit into creating a profitable business from scratch. The link for that is in the description below. And remember, don't just get better credit to save money, but use it to actually make money.